Welcome back, everyone. We are getting ready to start our second panel here. So, Tiffany, I'm going to hand it off to you, and we're looking forward to another great panel. The first one was wonderful, and we expect great things from you all as well. So, Tiffany, it's all yours.
Thank you, Commissioner Peirce. Thank you to the Commissioner. So thank you to the Commission, Commissioner Peirce and the Crypto Task Force for all of the work that they're doing in putting this together. It's a privilege to be here. I mean, I remember a couple of years ago talking to clients about how we really should have a roundtable on these topics, and here we are having a roundtable. So thanks again to the important work that you're all doing. In the interest of time, we're not going to have each panelist introduce themselves, but their bios are all available online. And they are all amazing. They have very different perspectives and backgrounds, and so it's really going to lead to a robust discussion. One of the main jobs of the Roundtable and the Crypto Task Force is finding a way out of here, as Commissioner Peirce would say. And so I hope that these diverse perspectives and the discussion that we have today will give some insight into how we get there. One important thing to keep in mind is that when we're talking about tokenization, we're talking about a market that exists today, that has existed for some time. And so we're going to be touching both on what's happening today and how we move forward into the future of tokenization, how we get to the benefits, how we eliminate the risks or mitigate them, and how we can help the industry reach its full potential. So with that lead up, we're going to start with a very big, grand question. And I'm going to go to Georgia for this one to kick us off. So how should we think of tokenization? Is it an asset, or is it a technology, or maybe both?
Okay, here goes. Just to quickly start, I want to say thanks to the Commission and to the task force. I'm honored to be here. I also would like to just express gratitude for the format that we are in today, where we can kind of eliminate all of the obligatory grandstanding before we just get down to the problems and the solutions. So let's get some solutions. When I think about tokenization, I think of it as a process that uses a technology. So it is a process that takes an asset and simply represents it and transfers thereof on a blockchain. As noted by both Commissioner Peirce and many of the other panelists earlier today, it really doesn't change or in general, it doesn't change the fundamental substance of the thing itself. So in this case, we're taking a security, we are tokenizing it, and putting it on a blockchain. It is still a security. And I want us to be very clear about that. Because it is still a security, it requires certain controls to be put in place. Things like AML, potential transfer restrictions, certain requirements about holders and their accreditation status. And what's great about using blockchain technology is we can layer that with a smart contract, which is written and administered by a transfer agent, let's say, or I love this term that has been being used, a tokenization agent, in order to create these controls that eliminate a lot of the risks that are intended on using just a pure permissionless blockchain. And so what do I mean by that? Well, one of the big fears with digital assets are that you lose the keys. And what do? The asset is gone. Well, by having a smart contract on top and a tokenization agent who can burn and remint those digital assets, that risk is mitigated. And similarly, if you have broken trades during transactions, or you have bad actors that try to steal the assets in some way, again, all of that can be remedied using this smart contract that sits at top. So importantly, I want to be very clear when we're talking about tokenized securities that we are not talking about the bearer assets of a lot of the kind of crypto native assets. We're talking about something that does have a lot of built-in controls specific to the technology and because of this technology that we're using. Thank you.
Hillary, what would you like to add to that?
Well, I agree that it's a technology rather than an asset. And when I think about technologies, I think it's helpful to think about what problem are we trying to solve with this technology, because I think that really helps us understand what's going on. So I think really it's clear that this technology isn't going to solve financial inclusion issues. I mean, you sometimes hear that discussed, but really half of Americans are living paycheck to paycheck. The issue isn't that there aren't enough investment opportunities, it is that people don't have enough money to invest. So I think what's really driving this is a desire for efficiencies for people who are already in the markets, more or less. So where are we trying to get efficiencies out of this? Well, there's a lot of talk about sort of making securities, digital. Most financial, well, at least most securities regulated by the SEC, I think have already been digital in some form or other for a long time. There are assets that aren't digital, and there's a lot of talk about real-world tokenization, but the challenge there isn't the technology. It's sort of reconciling the fact that you have one record of ownership and then physical assets that are out there moving in the real world, and how do you get those to match up? It's not a technology problem. It's a real challenge, but it's not one that I think tokenization really speaks to. So where I sort of see it, the discussion about efficiencies is sort of in two prongs. There's this sense that the public permissionless blockchain can bring efficiencies, and this sense that the composability and programmability brings efficiencies. And I want to note that they don't have to go together. Smart contracts predate blockchain technology. They can work with any kind of database or ledger. And I think that that's something to really focus on, given that the public permissionless blockchains themselves are inherently less efficient than more centralized alternatives. They have to be, otherwise it would be too easy for a sort of a bad guy, if you will, to take over the ledger. So I think it makes sense to really focus on experimentation with the programmability and composability on a more traditional type of ledger rather than the blockchain. And in fact, that's what we're seeing a lot around the world. So the Financial Conduct Authority in the UK does a lot of pilot programming with tokenization on permissioned ledgers. There's been a lot of experimentation by the Bank for International Settlements in that regard as well. So yeah, I do see this as a plumbing change, but I think we should think about why we want this plumbing change. And if it is about gaining efficiencies through programmability and composability, I think experimentation, it's sort of jettisoning the inefficiencies of the permissionless public blockchain are a good place to start.
Gene, do you want to respond to that?
One man's inefficiency is the other man's opportunity. I think it's both a digital asset and a technology. And one of the things we're doing with Permito Capital, a joint venture of ourselves and some ex-folks from Credit Suisse First Boston, is actually taking blue chip stocks and pulling them apart into their dividend component and everything else, and trading those separately both on the Chia blockchain and the New York Stock Exchange. The efficiencies here are really extreme. A couple things come to mind. For investors, you can buy 0.001 of a share. This has been a problem. I mean, you can do this in a sense at Robinhood because they will in the background make it work for you, but you didn't actually own that. And some of us have remembered 2008 and remember it was not a nice time to necessarily have to trust your broker or your clearing agency. But the other piece is in administering this product, it's going to be really difficult on DTCC. When an underlying company issues a reverse stock split or a spin out, being able to not decimalize becomes a tremendous pain in the derriere when you're actually trying to go and run one of these sorts of funds. And in fact, without the blockchain, we probably never would have done this sort of project in the first place. And my favorite version of this is tax. We're going to have to actually issue K-1s to people who invest in these so they can get their accredited investor dividend treatment. We have to pay about $300,000-$400,000 to someone who goes and searches down everybody's social security number and name in the brokerage firms in the US. On the blockchain, we write it once and you come in, signify that you've got your correct wallet or vault, and all of a sudden we generate your K-1 in real time for basically free. So, that is just a sense of what the opportunities are here. Now, I want to be clear, I'm talking about real securities. So there is no distinction in my mind. It's not, is Bitcoin a security? It's certainly not. But is a Microsoft dividend certificate issued by a Delaware trust a security? Absolutely, and it's going to be registered on Form S1. So I think that there are important points here that we can hope to choose regulations that would somehow box these things in. But liquidity and access are always hiding here. And so the reason that public blockchains are very powerful, even with their limitations of slightly slower transaction times, is not because, well, I'll say it this way, is an opportunity to have a 24/7, 365 market only mitigated by the size of the Pacific Ocean. So you're talking about a totally different liquidity profile for every asset out there. Today we only trade national market stocks during the day East Coast time. That is going to end pretty quickly as you start to see real assets that are tradable 24/7, 365. And I think there are opportunities there that people miss. The ability for you to rehypothecate, to be able to dedicate that capital in a different direction because you realize at 3 in the morning that something is amiss. So I think it is both, and I think you cannot ignore how much more capable the technology makes the asset.
Kelly.
Well, I represent one of the technology firms around the table, Public Blockchain, so it's probably not going to stun you all by telling you that I think of it as a technology and not as an asset. But I come more from the financial markets. So as I was thinking about the answer to this question, frankly, I was reflecting on the fact that I had started in capital markets in 1987, which actually means that I've seen all or part of 5 decades of capital markets activity. I've seen program trading and the advent of online trading, the introduction of the internet. I've seen the creation of derivatives and futures and options and ETFs and structured products and different types of packaged funds and the like. And it's interesting that this question gets asked. I think when I reflect on all of that, what's common as I think about all of those market cycles that I lived through is that the product creation or the product design led, and the technical implementation became the way of delivering that product design. So the market started with a conversation about some market anomaly or opportunity or aberration or gap that could be addressed or capitalized on. And technology became the follow-on conversation for how would I best achieve that or pursue it. And so there really was never the question of whether the technology was the asset. We were already talking about the asset, and the technology was simply how it was going to be delivered. And for the record, I hear every CIO I ever worked with saying, yes, that's the way it should be. Kelly, don't tell me how to solve something. Just tell me what the design requirements are. The difference is, though, is that I think here the reason the question gets asked is because we are leading with a conversation about the technology. We're leading with an understanding of how many of the things that we do in the market could be better or differently achieved by using a different way of approaching them with, oddly enough, something that's rather very simple and straightforward, a better set of database management, a better way of achieving books and records. But it's sort of that flip by talking about the technology first that I think has given rise to the question in frankly, a very logical way. And so, I joke when I was saying I'm representing Digital Asset, one of the technology companies, a layer 1 blockchain. Of course I'm going to say that. But really what I think is that it's, and I might say I echo a little bit of what Jean has said. I don't know if I'd go so far as to say that it is an asset, but I think it's the convergence of the two that is giving rise to the question and the discussion around it, meaning this isn't an asset creation first, and then how do I solve it from a technology perspective? My age-old question, the discussions I had with the CIOs and the businesses I was part of. Instead, what we have is a more virtual circle of discussion going on. First, tell me what the technology can do, and then let me think about how it can apply to some market instances or market anomalies. And then let's talk a little bit more about how the technology can address them, but what I need to be worried about. We are seeing, I think, the technology become part of the asset. The technology features are part of the definition of the asset itself. And I say this in a way that for all of the sobering thought that I have that I've been in a market condition for the capital markets across 5 decades of realizing that yet for all of that time, in all of the products that were created and all of the market cycles that I've been part of, it's always been a conversation about how I think about, yes, the market risk of something that I'm doing, or the credit or lending if I'm borrowing to do it, or how I feel about the counterparty that I'm interacting with. but it's always been the binding constraint of the settlement risk that I'm dealing with. We'll talk about market and credit and counterparty, but ultimately what I do is, and how the technology applies to solution, is often dependent on the settlement or on the operating constraints. They are the 800-pound gorilla in the room that ultimately dictates what can be done when and how. And I think what's different about this is we are now for the first time talking about unleashing ourselves from that binding constraint and knowing what it means to be able to define trading processes, services, assets, and their characteristics that are unbounded by those operating systems that can be managed, moved, delivered, is probably not the right word, but transferred in terms of value ownership 24/7 across a global market, across jurisdictions, and can do so at the speed of the internet in a real-time basis. So is it an asset or is it a technology? I think it's firmly a technology, but it's a technology that is now, and hopefully forevermore, ushering in an era where the asset and the technology are part of one definition of what's being created for market participants and what is being solved for from a market infrastructure perspective.
Excellent. Thank you, each of you, for those explanations. Before we move on to the next topic, one thing I'll throw out, and this goes perfectly to Kelly's comments. We've heard a lot today about the fact that a security is tokenized or put on the blockchain doesn't change the essence of what it is. But as I think back about some cases over the past couple of years, you had security-based swaps, or you had swaps, right? So is it that we've now coalesced around what a tokenized security is, right? Or do we still have other variations we should be thinking about and being clear about when something is a swap and does not have all the rights and privileges of the actual security versus being a tokenized security? So I leave that to anyone who wants to answer.
That comment struck me as well in the earlier panel about once we have this stock security, this tokenized security, it's not a different animal when we put it on a public blockchain than it would be otherwise. And I'll talk about this more, I'm sure, when we get into like the risks of these tokenized securities. But from my perspective, it's a very different animal because it has a totally different risk profile. And the risk profile changes because of the operational risks and the risks that participants within the underlying blockchain systems will act in ways that change the record-keeping reliability. So I disagree strongly with that characterization.
Interesting. So Gene's going to get in before we go to the next topic. Go ahead, Gene.
Yeah, I would just say, I think it really matters who the issuer is. And what I mean by that is, when you're talking about a corporate issuer or, a well-known issuer 40 Act company, those kinds of things, we have a regulatory regime for all of those issues. So when you're dealing with a direct issuance, and this is why I don't like the word tokenization too much, because it often has this implication that some third party is going to put a basket of stuff somewhere and they're going to sell you that. But if you're actually the issuer, there's no real difference. It's just that you're now actually disintermediating a bunch of steps between the issuer and yourself and can actually self-custody directly and go back to like the 1930s about how you actually could hold securities and manipulate securities. So, I think it comes closer to being a security-based swap when it's not the traditional issuer in the issuer word's sense.
Yeah.
Can I add just a quick point?
Go.
Yeah, I think when we think about respect the other opinions on the panel entirely, but I think that when you're talking about tokenization, particularly of real-world assets, a U.S. Treasury and a tokenized U.S. Treasury are one and the same thing. They are not two separate things. They are not a separation of their features or their functionality or the rights and obligations and conditions. They are one and the same, or at least that's the intent, and that's hopefully what comes out of the work and the discussion that we're having with the SEC and other regulatory authorities. And I think that's really important to understand. The technology applied to the tokenization of a real-world asset is frankly, in many ways, no different to the dematerialization that occurred when we went from paper form to electronification form. There will be new tools, new ways of interacting with that asset. There'll be benefits, there'll be challenges that will need to be managed for sure. But a tokenized real-world asset and a real-world asset and its tokenized form are, in point of fact, one and the same, and therefore not adding any inherently different risks or governance or oversight activities that wouldn't be required of the asset itself. And that's why it's critically important that we think about it as the expression of the regulatory requirements, the shape of that asset, and the legal and contractual requirements on transferring it between parties is translated into a digital form. And that's really not more than that when we call it tokenization.
Excellent. So let's move on to the next topic, starting with Johan. So can you walk us through some of the benefits of tokenization?
Yes, absolutely. I think we have been discussing a few of them already in the previous panel, but actually just because we discussed about financial inclusion, we do believe at Robinhood that tokenization can reduce a lot of the barrier for retail and advance the way for investors that are usually kind of excluded from the market to access sophisticated markets. We also think that it will encourage innovation in the industry in areas like microfinance, tokenized remittances, local capital formation. And we do believe that the financial inclusion will come also because of the fractionalization like we discussed. That is something by default, and if you're trying to be a retail investor investing for the first time in a large stock like Amazon, having fractionalization will be something that is extremely important. There will be also the reduction of cost because we are removing middleware and middlemen everywhere across the trade. And we also think that we will be able to increase competition. I don't know if any of you has tried to transfer from one brokerage to another and use the so-called ECAD system, but it will take multiple days. You don't really know what's happening. And because of this friction, many people just stick with their current broker. And so we think that with tokenization, we can actually make this process seamless, instant, and bring a lot more the power to customer to decide which broker they should use. So that's one aspect on the financial inclusion. And then some of the advantage that we discussed before were around the liquidity and market access. We think that offering 24/7 global access will reduce the reliance on the broker, on the market hours, and that's also something that will include more and more of the retail space when they can actually trade when they are not at work or when they are not blocked from using an application. There will also be cost and operational efficiency. So I know we talked a lot about real-time settlement before. T+0 is definitely something that is ambitious, but at the same time, the capital requirements that will be reduced because of this are extremely important, and also the credit risk. And so that will increase the competition in the market. That will allow more institutions to come in. And the worry around net settlement and things like this, like we discussed before, this can all be solved with the right implementation, with the right smart contract, with the right use of stablecoin versus cash and these kind of things. So, I think we need to be convinced that some of this problem can be solved with technology and not just stop there because we are worried about it. And then one of the two other points that we really care about is transparency and compliances. Blockchain provide a verifiable audit trail, which is something that is very important. Compliance rule like KYC, AML, and everything can be coded directly. We already do that for many of crypto transfer, and so it's something that is really easy to apply to tokenization of real-world asset. And finally, I think the price discovery and capital formation is going to be one of the main key points. Tokenization will open new capital channels, and global marketplace will actually develop around it. We already see it in other places that have been a bit more advanced in tokenization, like in Hong Kong or in Singapore. And we see a lot more of this investor participation in that space.
Excellent. Joshua, you have anything to add to that?
Yeah, so I am probably the odd person out on this whole day. I represent a VC, and we invest in startups that are building in the space, kind of rather than coming from kind of TradFi or at an operating company. And I've been in the space for 8 years, and I used to kind of jokingly, when I would sit on panels, ask if there was anybody from the SEC in the audience, and so they caught me, and jokes on me, they've dragged me up here to ask me questions, but I think what that represents is a really incredible shift in the discussion opportunity. Basically, I've spent the last 8 years of my career trying to convince people that this is a real life technology. I believe it's a technology. And that it has real applications for capital efficiency and financial inclusion, and to expand, right, not replace, but expand our financial rails, right, how we move capital assets across the globe. And so in light of that, I think Commissioner Crenshaw had some interesting questions, and I want to address some of those. So scalability, again, from the perspective of someone who's investing in this space for a long time, are blockchains as scalable as centralized repositories for trading activity? No, they're not. Not today. They're not as efficient. They're not as fast, right? But let's look at the trajectory of the technology over, call it, the last 10 years. So we're coming up on almost 10 years of Ethereum being a chain. Let me just use that as an example. Many people know it. When it first launched, we had a whopping transactions per second of 15. Just 15, not 15 anything else, just 15 transactions per second, which is paltry, right? Fast forward about 5 years later, we have the advent of rollups for that layer 1 blockchain, and that increased to about 1,000, right? 1,000 transactions per second. That sounds pretty good, but actually it's not, right? We're 100x at least that in terms of traditional financial markets. Today, 2025, we're looking at least experimentally, but increasingly in live scenarios, right? We're looking at 65 to 100,000 transactions per second. Right now we're talking about actually being competitive with some of our centralized trading systems. That's really important. So yeah, today we're kind of still not there at a global scale, but again, as someone who has spent so much time trying to birth a new technology into the world, this is what we expect from technological progress, right? We expect things to get better over time, right? And I think that's going to be a theme, at least for me, for this panel, of trying to identify why there are benefits to be achieved from engaging with this technology and allowing this technology to facilitate the types of activity that we already do in traditional markets, and also new types of activity with new types of assets and new types of financial primitives. The other thing I want to talk about is settlement cycle. So is it a benefit? Is it a detriment, right? I appreciate that netting is something that traditional financial markets participants enjoy the use of today. I think a really important point made in the prior panel was the fact that what we were talking about with T+0 settlement is providing optionality for marketplace participants. Netting does provide efficiencies. It's helpful. It still requires margining, so it doesn't eliminate costs of trading. And there may be times where your preference for your ability to net out transactions over the course of some set period of time outweighs the cost of margining and collateral that is still required for that transaction, for that process. But wouldn't it also be great if you decided that you didn't want those costs of capital and you instead wanted to be able to transact atomically in instant settlement, right? So those are things that very difficult to do when you have layers of intermediaries that are inserting themselves by necessity, right, in the execution, clearing, and settlement of transactions, right? What this technology enables is the automation of many parts of that system, right? We're enabling automated action that is taken by, code, mathematics. That code doesn't have self-interest, doesn't have people that kind of work behind the scenes as you would have at a clearinghouse or a broker-dealer or a centralized exchange, right? That code is going to execute on the basis of rules and principles that have been built into the system, right? Surely there is benefit to being able to rely on the programmatic execution of processes in a financial trading market, right? And then, another point was, well, there's just not that many people use these markets, these decentralized marketplaces, or engage with tokenized assets. That is true. In 1995, not that many people used the internet as well, right? And so again, like we need to think about how this technology progresses. I would say that it's probably our preference in our best interest from regulating markets perspective that we not hope to engage with this technology once it is fully baked and we've answered all the questions, right? But instead, we come to the table now and enable some of the market participants today, like some of the panelists from, I was honestly really surprised to agree with many of the things that the panelists on the former panel said, right? People want to do this, and so we need to find regulatory solutions that enable participation in these types of ecosystems.
Thanks, Joshua. So we're going to go. So that's kind of laying the foundation for something we're going to talk about later. Now, before we get to the future, right, and what should happen next, let's talk about, we did a nice job summing up the benefits of tokenization. I think Sid wants to add something.
Yeah, I think just before we move on from the benefits, one of the things that I can talk about is just our practical experience tokenizing private credit. So we effectively have kind of two core products at Maple. Both involve secured lending to institutions, which is over collateralized by digital assets. But I think for one of the products that's available here in the US, what we're able to do by tokenizing these assets is to give the lenders, the capital providers, visibility real time into the performance of the portfolio. So one of the key benefits is transparency into both the performance of the loans as well as the collateral backing of the loans. Another thing is that we're able to settle these loans pretty well instantaneously. So we've actually done settlements of loans at 10 p.m. on a Saturday before. So we're not really constrained by the use of the banking system. And then the other element is liquidity. So people who provide capital into these forms of loans are generally able to get that capital back within 30 days. And that's because when somebody puts money into a pool, the loans are being repaid all the time. So a repayment from a loan can allow a redemption of capital, or a new deposit from somebody else can allow that redemption to occur. But the other interesting thing I thought I'd touch on is that we also have a version of this product that's indeed a little bit more relaxed from a DeFi perspective and is a little bit more DeFi native. This product is not available in the US. However, with this product, we can kind of see an A/B test being run in real time. So the product has secondary liquidity, so you're able to swap it on Uniswap, other decentralized exchanges, and this allows the user or the holder of that tokenized asset to get much better liquidity and the ability to redeem at a much faster rate than somebody who's in the other product, which is only limited to accredited investors. We've also seen an increase inclusion in that we often see deposits or inflows that might be $5 or $10 in size. So it does broaden access to more of a retail offshore market. And then we're actually able to see composability used in other DeFi protocols. So for anyone who's familiar with DeFi, there is a tool called Pendle, but what this allows you to do is to lock in fixed rates. So you can actually take this portfolio of private credit and then fix the rate that you're receiving from those loans. And then finally, one other point I would make is that you can actually take the tokenized asset and use it as collateral in DeFi borrowing markets. So another integration that exists is Morpho at the moment. And so we've seen over 50 million pledged as collateral to be borrowed. But it just goes to show that some of the utility when you actually enable this interoperability is more participation at smaller size, being able to lock in fixed rates, being able to use it as collateral, and being able to access secondary liquidity on these assets.
Gene, you have something to add?
Yeah, and it's a small detail, but I think it's an important detail. When we talk about fractionalizing shares or decimalizing shares, there's an aspect of an ETF involved here. In the past, if you wanted broad market access, you generally had to use an ETF, even hedge funds that do this. But with the actual fractionalization of shares, you can say, hey, these are the 70 QQQ stocks that I care about, not the 100. And I can actually only take $5,000 and get exposure exactly like that and self-custody it. That is a thing we haven't really had the ability to do before. And so I think often when we're talking about some of these high-level terms, it's important to understand what it's really going to enable people to do.
Excellent point. So let's talk about some of the risks and challenges of tokenization and then how regulation can help protect against these risks and challenges. Let's start off with Hillary. It's been a while.
Okay, I'll try and be brief because I got a lot. So as I mentioned before, there's sort of two halves of this. There's the, are you going to do this on the permissionless public blockchain and the risks associated with that? And then there are the risks associated with the smart contracts, the programmability, the composability. So I'll start with the blockchain. So to a point that Angela already made, I mostly think that the heuristic of same activity, same risk, same rules makes sense. But when you're dealing with operational risks, that breaks down because new technologies do bring new risks. And there are a lot that we need to think about in the context of blockchains. Who maintains the blockchain software? Who are the validators? How are they regulated? Really, we have a whole infrastructure around regulating financial market utilities, particularly the PFMIs. I think the SEC really needs to look closely as to whether that's going to be applied to public permissionless blockchains if they are going to be infrastructure for real-world transactions, which, as I said, I do not recommend. There's the challenge that using public permissionless blockchains brings in new intermediaries. We often hear about it eliminating intermediaries. It really doesn't. I mean, you can look even at DeFi where you have to trust, whoever's maintaining your blockchain, whoever's validating your transactions. You have to trust the oracles that are being consulted for data by the smart contracts. So there's a lot of intermediaries there. They're not always the ones that we're traditionally used to regulating. They're also ones that may not even be obvious or visible. So I think there's a lot of risk associated with those new intermediaries who need to be addressed. I think Commissioner Crenshaw did a good job of talking about all the challenges that come from using these blockchains in terms of eliminating netting. I think there's sort of this sense that faster is always better and 24/7 transacting is always good. You can protect individual investors, but individual investors are all going to be harmed if the system collapses. And those kind of efficiencies in good times breed a lot of fragilities for bad times. We've seen time and time again when there's financial crises that pauses are the moments where you can stop, collect, fix things. I think if we eliminate all the pauses, then that's something that we'll come to regret. And I'll talk a little bit more about that when I get to the risks associated with smart contracts as well. There's also the issue of, Josh mentioned that scalability is getting better with blockchains. A lot of what's happening there is stuff happening off the blockchain. I think there are limitations on how scalable the blockchains themselves can become simply because they have to be inefficient or else it's too easy for the bad guys to take them over. So what we're seeing is lots of links between blockchains to try and create liquidity. And that's usually done by way of APIs. And so APIs also introduce a ton of operational risks. They are usually the most vulnerable from cybersecurity perspectives. They can also transmit problems from one chain to another. So that's another locus of operational risk that I think we need to be very careful about if we are going to put real-world assets on any kind of public permissionless blockchain. So now I'm going to shift a little bit and talk about the risks associated with the programmability aspect, the smart contracts. So here what you're trying to do is essentially pre-program for all future states of the world. And there is always uncertainty, right? And we have seen time and time again that when things are going wrong, a little bit of discretion, a little bit of grace, a little bit of flexibility is often necessary, even on sort of small scale interpersonal or sort of party-to-party transactions, but especially at the systemic level if things are going that big. You know, margin calls, if you automated them without allowing for any kind of intervention, could, in some circumstances, precipitate a full-blown meltdown. So we need to think, again, about the trade-offs between efficiency and fragility from pre-programming all of our transactions. There are sort of ways you can deal with that. You can have the smart contracts sort of reach out to an oracle, which is a data source, and that oracle could be used to pause transacting in the smart contracts, but that's going to require a lot of regulatory intervention with regards to the oracles, and that's something that I think the SEC needs to think about. There's also the financial stability risks of integrating traditional finance and crypto. Typically, crypto busts have been sort of kept contained within the crypto ecosystem. I worry that with more and more integrated products that sort of, you know, where a smart contract is sort of used to link a traditional financial asset with a crypto asset, that we're in a position to transmit risks within the very volatile crypto ecosystem into traditional finance more easily. One last thing, and then I'll stop, even though I could go on. I want to talk a little bit about fractionalization, because we hear a lot of talk about how tokenization enables this. Well, we've had fractionalization before. I mean, it's more or less securitization. And what we've seen is that when you sell pieces of assets rather than the whole asset, you can have a lot of liquidity problems. Because it's not always easy to map ownership of a piece of the asset onto the broader asset. And what that means is that in times of panic, people aren't going to be able to be sure that they have title to the full asset. They're only going to have title to their piece. Well, what's a bankruptcy court going to do with that? If I'm unsure, I'm going to panic. I'm going to start selling it at a discount. That's going to press down market prices. Then we could have spillover effects. So, you know, there are individual risks in all of this, but I really think it's critical that the SEC put on its sort of market financial stability hat as well as it looks at all of these and sees the fragilities that are the trade-offs for the efficiencies that are being marketed.
Thanks, Hillary. So I know we have a couple of operators here who've been working in this space, thinking about these issues for years. So I'm going to get at least two. Let's start with Sid, because I already told you I'm going to call you for this. So let's start with Sid, and then maybe who wants to raise their hand for next, then Georgia. Okay, so Sid and then Georgia.
Yeah, I think there's definitely some notable risks to tokenization that Hillary touched on. I think the ones that are kind of most evident to me as an operator in the space would be fragmentation of liquidity. We find this a lot when we're looking at which blockchains to deploy assets or our lending to. Most of our lending is currently done on Ethereum mainnet, so that's kind of where 90% of the volume lies today. And if we deploy on other blockchains, then we risk shrinking the business because we have all of the liquidity on Ethereum mainnet and not on, let's say, Solana or Avalanche or whichever other chain we're looking at. So I think this obviously poses a problem if you have one type of asset that's significantly less liquid on another chain, then that's going to be problematic for the holders. I will say that we are starting to see the market kind of take care of this problem. There's a few teams, notably Layer 0, Chainlink, Wormhole, who are trying to create interoperability between blockchains. And presently, we're evaluating all of these solutions, but I think we have decided on one. But where we will play this out in a real-time experiment will be the offshore private credit product that we have. We are going to be bridging that to different chains, and so I think this is an example of hopefully the fragmentation of liquidity becoming less of a problem through technical solutions that are being provided. I think the other notable area, though, where we see challenges with tokenization is, I was going to touch on the discrepancy between on-chain and off-chain records. This is definitely important. As Hillary noted, you might have title which lies off-chain on a legal record, but somebody else holding the token which they've purchased either OTC or they might have purchased on a decentralized exchange. I think this is one. This is a problem that we have encountered firsthand. So we have tokens which are not transferable that represent an interest in private credit loans, and then we have another version of this product which is transferable but similarly represents an interest in a portfolio of loans. But that product carries less rights with it because it's very difficult to attach the rights to tokens themselves. So I'd say this is an area where regulation can be very beneficial in assisting innovation in the space. If you're able to find a way to attach rights to tokenized assets, then I think that would be very important because it will just allow the two to operate in harmony. So you won't have a contract that says one thing and an asset that's being used on the blockchain that operates in a different kind of way. And then the other thing I would say is rule of law versus rule of blockchain. So we have legal contracts that govern the loans that we do, and then of course we settle the loans on-chain using stablecoins. So here you have the actual rule of law is applicable to the underlying rights of a lender in what we do, and I think it's very important to find a way to either codify that on-chain or recognize and once again link that to the tokenized asset itself. And the other point, circling back to liquidity, I think if you're able to enable transferability of assets in a much simpler way, so this probably gets to KYC frameworks and how that needs to be done. For example, if I want to pledge a tokenized asset as collateral, and then the person that I'm pledging it to needs the right to be able to sell that, it's going to be much more beneficial if they can obtain a liquid price for that asset rather than needing to go through a much smaller segment of potential buyers that they have already KYC'd. And I'm talking about the use of decentralized exchanges in that instance. So I think that gets more to how we treat KYC when it comes to the KYC and AML regulation when it comes to these assets. But those are just a few of the points that I've noticed actually operating in the space.
Excellent. Georgia?
Yes, so just in the spirit of fulsome discussion, I was going to give a few counters to some of the risks raised by the use of public permissionless blockchains. And so just a few points that I'd like to raise are, Bitcoin is a blockchain, and it's been around for a while. And I think it's had less than 1 hour of downtime in the 14 years that it's been running. Number two is that public blockchains offer a better audit surface and transparency and resilience to insider risk. So transparency actually is the feature, not the bug. And when blockchains fail, it is public and it is noisy and it causes a commotion, but we know about it. And the public can come in and make changes and remedy the situation, leading to a stronger and more resilient blockchain. What happens when private systems fail is, well, I don't know, actually, because I get a letter in the mail like 2 years later from my bank saying, well, something bad happened and here's a subscription to Lock Life, hope it helps. Also, I think another thing to really keep in mind is that our economy really runs on open cryptographic infrastructure. Like our whole world, frankly, our information systems. So like the internet, TLS, SSL, Chromium, Firefox, WebKit, Linux, all these are open infrastructure, are open cryptographic infrastructure. So we do have test cases of this. I know there was concern about APIs, and APIs are a risk vector, absolutely, no question. But our financial system already uses hundreds of thousands of APIs. Swift is basically an API. And then I think finally, the most important point I want to make about all these risks, which I am not trying to make light of, I am just pointing out some mitigants, are that I think the strongest mitigant is when we talk about tokenized securities, we talk about an infrastructure that has these smart contracts on top that aren't running headless amok, but do have a tokenization agent to write and administer them to ensure that when the bad things happen, there is someone to be held accountable, but also to remedy the wrongs.
Excellent. So I know Angela and then Kelly. So let's make sure we can talk, we can respond, but let's also give recommendations. Like, right, it could be that the market will fix certain risks. They'll be mitigated that way, or maybe you need regulations to get them. So let's make sure we touch on that.
Okay, so I recently put worst case scenarioist in my X bio, so that's what I think about. You might have noticed that Hillary, I think, does as well. My concerns about the risks of these public blockchain systems, which it's very interesting to me because I've been in this space for a long time now. Started researching in about 2012, and have been through the discussions with the about what's going to happen with the financial sector moving its all of its record keeping onto blockchains. And in the 2016 time, it was all about it's going to be on permissioned ledgers, and so there was a whole flurry of building there. And public blockchains are far too scary. And today we're sitting here in 2025, and the tone of the first roundtable was very much that, well, duh, of course we'll get all these benefits of tokenization, and we'll just use this awesome record-keeping system that is there, these public blockchains. And there was a hint, I think, towards the end of the first panel about some of the risks of the public blockchains, but it was very much kind of glossed over. And I wrote about using public blockchains as financial market infrastructure way back in 2015. And I pointed out to these operational risks that exist within how software is developed in public blockchains, the maintenance of them, how they deal with emergencies and things like that. And so why am I up here beating a dead horse? Because these things haven't changed, okay? What's changed is the perception of public blockchains as legitimate. And we know that they've been here now for 15 years, and therefore they must be legitimate. They've had limited downtime during that time. Well, I would assert that just because they've endured a long time does not mean they're legitimate. Just like I would say for me, just because I've endured as a researcher for a long time doesn't mean I'm legitimate. You have to look at what I'm saying, right? So I would analogize what we're doing by saying, okay, well, they've been here long enough so we can put all of the, financial system record keeping on them, to kind of building a bridge and letting a bunch of kids play on the bridge with their little toys and their, doll carriages and everything like that. And then saying, okay, it's been here 15 years and nobody felt the bridge held up, so we're going to start driving Mack trucks over it now. Okay? It's a whole huge weight that we are wanting to put on these systems with the record keeping. Hillary did a great job highlighting a number of the operational risks. I would just like to make them a bit more concrete for you. So I just would like to say that Bitcoin, Ethereum, and Solana are kind of, big blockchains. The first two particularly have been around a long time. And we just heard, and I apologize, I can't see everybody's name up here. Georgia. We just heard Georgia talk about how things are public when things go wrong, and you can know what's going on and you can make adjustments. But that is not true based on the history of these public blockchains. Bitcoin had its secret bug fix in 2018, where some core developers and a few validators miners who they contacted individually noticed an inflation bug in the code that they fixed and did not tell anybody what was in this upgrade that the select miners ran, right, before it was announced weeks later that this had occurred, okay? Could have been catastrophic for the blockchain. People couldn't make their own decisions in real time, gave a lot of power to those people who were in the know who could have definitely, traded on that information. Same thing happened with Zcash. This time it was a flaw in the cryptography. This was around 2019, I think, where again, there was a secret bug fix amongst very few developers and validators who knew about this. Nobody else did, could have decimated the system. And lest you think these are old problems, I think I was just checking before we came on, there's a May 5th article about what happened in Solana this month, where there was, again, a catastrophic flaw in the cryptography used in, I believe, in there's zero-knowledge proofs, that a select number of developers and a select group of validators that they invited in made the bug fix, updated the network with it, didn't tell anybody what was going on until it was already resolved. Now, of course, this is probably a rational way of governing these systems, right, where you want people responding in an emergency who know what to do rather than let the system go down. But the people who are doing this have no obligations. Like, I've argued for years they should be treated as fiduciaries because they're caretakers of the system, but we persist in acting as if these systems are not controlled by or maintained by or that humans do not have critical roles in operating them. And finally, I just want to make one other point about our assumptions about the stability of blockchain systems have to do a lot with our belief that the game theory that is embedded in these systems is adequate to regulate them. Okay, so as long as the game theory works, then you don't have any people who can take advantage of things, who can attack the system. Like, it will always be protected and stable, right? The stability of these systems is why we think tokenization and using all financial record keeping, doing all financial record keeping on them is a good idea. But assuming that the game theory will work assumes that the system is closed and is not vulnerable to changes that occur outside the system in the real world, right? Thus changing all the incentives within the system. And just as one example of this that has become a huge deal across all blockchain systems that was not anticipated was the phenomenon of MEV, which was called minor extractable value initially. It's now taken on a new name, maximal extractable value. But I want to focus on just the miners or validators who are in this position. And basically, it was assumed that miners would only be paid within the system. But once they start taking payments outside of the system, right, that changes the incentives within the system. Once you start building layers, layer 2s and probably layer 3s and layer 16s at some point on this, that changes all the incentives at each of the levels along the way, right? So they become less predictable, and predictability with your record keeping of the entire financial system is kind of an important asset. I have many more things to say, but I will stop.
Okay, yeah, I know everyone has something to say. So Kelly is going to have the last word on this. And the last question of the day will get at this very dialogue we're having right now. I promise you we'll come back. So Kelly, go. Then we're going to have one more topic, and we're going to come back to.
Okay, and I'll
wrap
try and be quick. I was just thinking about. I think there's some excellent points that have been made, and we are in the privileged position of getting the opportunity to work with a number of financial market participants, many of them. The large market FMIs that are doing real-world implementations with this technology now. And so I thought I'd just add a couple of comments on what's driving that and what, I don't know if they're really benefits or risks. I think it is absolutely appropriate to suggest that any new technology, any new operating system or operating activity of any point in time, if there are human beings involved in it, it is going to require some level of new governance or assessment of risk and the like. And so there's nothing about this that would actually change that. I'm also conscious of what I heard in my head when Commissioner Crenshaw spoke earlier of, be careful of the adage that when you're a hammer, everything looks like a nail. And so when I bring it back to thinking about what are those real-world implementations, and what risks or benefits or opportunities and challenges are they managing? What's emerging? Much of the discussion in the last panel focused on collateral management. It was near and dear to my heart. I ran collateral management and securities clearing at JP Morgan for over a decade, including around the crisis. So plenty of stories that talk about what technology failed at that time and the countless things we can do to improve it. But when you think about 24/7 markets and collateral mobility and the opportunity to tokenize the highly liquid real-world assets. Well, just to give you a statistic, there are 255 trillion or those of marketable securities in the world that are in demand for use as collateral in lending and as margin and the like. Only 28 trillion, which I realize is an enormous number, but only 28 trillion of the 255 is currently being used. That's about 11% of the market. I'm not arguing that, or the projects that we're working on isn't to suggest that, well, let's get to 97, 99% of that, but even doubling that amount has the important benefit of unlocking capital efficiency, liquidity, and financing on a real world and a global scale. And when you can have access to liquidity with transparency, not without privacy, but with transparency, where you know where your assets are being held and what they can be used as to meet collateral obligations, what they can be used to generate in terms of credit or liquidity, that improves market resiliency. So none of these projects are marching towards that with unbridled, sort of misplaced enthusiasm for let's throw out all of the rule book and go towards this wonderful new 24/7 operating model, but it is about having a much more calm, controlled way of looking at the world and saying, if I can unlock and mobilize assets to be unbounded by traditional settlement, sort of these exogenous batch processing, cutoff time settlement systems, and give market participants access to be able to use their assets to generate liquidity and capital efficiency around the globe, that has a much more solid, stable, systemic effect on the stability of global financial market operating activities. There is also operating efficiency. I think when most people got into blockchain and most initiatives that we work with, there was a level of focus on the operating efficiency and sort of eking out those manual processes that are still really defined in the post-trade space. Many of the efficiency, the market advancements that we can reflect on for the last 2 or 3 decades were largely around the pre-trade and the trade, the execution, efficiency, and the creation of new products and services, and left to sort of the sneaker brigade or the legions of people to deal with it from a post-trade perspective. There was a recent report that was done by the Value Exchange and DTCC, Christian's organization from the last panel, on corporate actions, which I realize might be, as exciting as mud in terms of activities in the post-trade space, but is one area of the post-trade market that is just highly inefficient. And what that study showed is that an average single U.S. corporate action had 1.1 million interactions with it across the industry. There were 1.1 instances of that corporate action needing some form of intervention or action on it. And when you extrapolate that into the 600 or 1,000 or so U.S. corporate actions that occur per annum in the year, that meant that there was about 400 billion worth of cost associated with it, 160 billion of which was deemed to be duplicative, unnecessary, manual activities. And so, I think about what Commissioner Crenshaw gave us as sort of a warning system, but what Commissioner Peirce gave us as a challenge to pursue those opportunities. It goes back to thinking about, and for all that we're all talking about here, it goes back to thinking about the issuer and the investor. And ultimately, can the issuer get access to debt and equity capital markets for their organization in a more efficient, more real-time, longer, more global way, in a way that's public and can access more investors into their organization? And can you run the time frame and the activities between issuance and investing in a way that returns more of that yield, whatever the market will bear, to the ultimate investor? And so when I think about corporate actions and the work that DTCC and Value Exchange did, who wouldn't want that 160 billion to be taken out of the market and returned ultimately to the investors? So I think it's good and sobering to think of every new technology, every change in operating system to be one that should be taken with humility and reverence for the rule books that exist and the decades of regulation and the decades of market activity that have gotten us to a different point, and to be aware of those risks, but to not let that prevent the pursuit of transformation and the opportunity to eke out waste and inaction and inefficiency so that you ultimately can get to a better and more efficiently operating capital markets for the issuers, and an opportunity for the taking on that risk to be returned more to an investor. And those are what we see in the real world projects that are existing from a production implementation now for our technology.
Perfect, and that was a perfect segue. I'm going to start with Johan in talking about the sandbox that Commissioner Peirce talked about last week in her speech. So you can give some thoughts about what your impressions were and generally how you think of that type of approach to getting to the benefits of tokenization while also balancing against potential risks.
Yeah, absolutely. And we welcome the proposal for a sandbox environment, which will actually provide the firms with the ability to tokenize securities on a level playing field. And I think this level playing field definition is important because we see a lot more participants in the market starting to create some kind of tokenized securities. And I think it's going to be important at some point that we are all acting under the same rule. Overall, we support market integrity rules, and we really welcome the SEC to act quickly to move from the sandbox to an actual durable regulatory framework that will provide the regulatory certainty that we all need to participate in the space. But I think instead of adopting a formal regulatory sandbox structure, it might make sense to organically create a sandbox by providing targeted market-wide exemptive relief aiming at alleviating the pain points that are preventing tokenization from taking flight. I think if you look at other sandboxes that have been created in Europe, for example, the DLT program has never really taken off because of many limitations in place and the number of participants that could come in, the amounts that they could actually trade on it, and other limitations really prevented the program to become this real A/B testing that we were looking for when it was announced. And so we think that such relief might address, custody requirements under the customer protection rule, whether the digital asset can be allowable asset and required haircuts under the net capital rule, and things like this. The other aspect that we think is important with the sandbox is that it's going to encourage market participants to experiment and take risk, the risks that are necessary for the tokenization of securities to become a reality. But we overall think that any exemptive relief should be conditioned on compliance with requirements aimed at investor protection, things like anti-fraud, anti-manipulation disclosure, reporting requirements. If we want the sandbox to work, it has to be safe. We heard multiple worries just today, so we need to make sure that the sandbox take care of them. But overall, we think that the sandbox is a temporary measure until Congress develop a permanent legislative framework for tokenization.
Georgia?
Thank you. Yes, well, first of all, I heard I wasn't supposed to call it a sandbox, but we definitely welcome, some sort of temporary exemptive relief with respect to tokenized securities. I think one thing that I'd like to point out is just, I don't think we need a lot of exemptive relief on the 33 Act. Like, we all agree these are securities, so we've got pretty good frameworks for the disclosures and the issuance of securities. And like we've been saying, like the tokenization of them does not change their essence. But we would need to see a little relief with respect, or at least just clarity with respect to the custody and trading. And specifically when we're talking about atomically settling these trades where NMS regulations really are not fit for purpose, and even just clarity around the ATS requirements and what would be needed with respect to atomically settled transactions, and then thinking through custody on these certain exchanges. Do you want to allow omnibus? Do you want to require atomic settlement? What kind of risks and rewards do we have? Maybe, I'm a big fan of choice, so I think allowing, investors to choose the type of settlement cycle. I think Joshua mentioned settlement cycle, and I think settlement cycle is a choice. I feel like investors should be able to choose based on the risks and rewards of, T+2, T+1, T+0, whatever really suits their needs. And it's not my job to make that decision. I don't think it's the Commission's job to make that decision for investors either. So yeah, ultimately, wrapping this up, sorry, I think we are very supportive, and we just want to be clear that, again, these are securities, so we still need to treat them like securities.
Josh?
Yeah, so I think we could spend a lot of time debating the measure of catastrophe associated with certain blockchain failures. I think that is pretty generous, but we've seen very consistent performance across major blockchains for a number of years. The fact that BlackRock and Apollo and Franklin Templeton are comfortable engaging with these systems, you would expect that they don't just kind of like make those decisions haphazardly. And from our perspective, we have spent a lot of time thinking about how these systems are actually built to be very robust, right? So there are updates to blockchains, but they happen in coordination across disparate participants, not centralized actors. And that changes things, right? Because you don't have one entity controlled by one group of people making changes that aren't in the public eye. And so I think like that is really important to keep in mind. Now the question is, how do you, so we could debate that. I think the reality of the circumstance is that even if all due respect to being in the SEC right now, thank you for having me, the SEC is not going to be capable of regulating blockchain validators as intermediaries, even if they wanted to. It's global technology. It's not going to happen. But the question is, so what can you do? Well, what you can do is, particularly with respect to tokenized securities, right, which is squarely within the Commission's purview, is you can regulate the intermediaries that want to engage. So you're talking about transfer agents and broker-dealers, right? What you can do is you can put requirements on transfer agents and broker-dealers to get informed consent from their clients around trading digital assets in public blockchains. They can have some type of kind of diligence requirement that requires them to understand the structural components of the public blockchains that they engage with and work in, right? You can give market participants the opportunity to have choice to determine whether they want to engage with a new technology, right? In the grand scheme of things, I like Kelly was throwing around some really massive numbers, which is amazing. Those are too big for my brain because my industry is a $3 trillion industry, not like a $250 trillion industry, right? But in the grand scheme of things, these ecosystems are not going to be systemically risky to the rest of the financial ecosystem, but they do provide opportunities for market participants to engage with technology and take advantage of the technological advancements to do new things that the systems provide. You can enable transfer agents to, you can free them up to use the programmability of the technology to ease the burden of some of the record-keeping requirements and some of the custody requirements, again, around tokenized securities, right? Tokenized securities are not bare assets. They're permissioned, right? The transfer agent, or maybe I like tokenization agent as well, they can provide the top layer infrastructure that enables issuing permission securities even in permissionless ecosystems. And so those are things that the commission can engage with, that we can create sandboxes, sorry, I forget what we're supposed to call it, but sandboxes around, right, that enable participants who are technologically capable and interested in engaging in this ecosystem to do in a way that is relatively safe. Every technology has failure modes. Every technology is imperfect and in a state of growth and kind of improvement over time. And so we could debate about what the margins are for blockchain systems, but I think what's more helpful is providing ways to engage that enable us to continue to grow with this technology.
Thank you. So we have about 5 minutes left. So my final question, and this was brought on both by the dialogue we had here and what I saw earlier. So it seems to me you have folks with very different views about how to move forward based on their industries, whether they come from TradFi or Disruptor, whether they're academic, et cetera. And so, if the goal is finding a way out of here, I'd like a few people to comment on, from the SEC's perspective, if you're getting input that's totally different, right? We can have this roundtable we were here for a couple of hours, but I think that discussion probably could have went on for probably 8 more hours, right? So what's the most efficient way for the SEC to get the varied feedback and have that debate so that it has it in mind as it's trying to move forward? Angela will start.
I've been thinking about this for a while as well, and it's true, we have very different perspectives on things, and one of the things that has most concerned me about the discussion and the process of thinking through what regulation should be and whether there should be regulation at all has been, a disagreement based on the facts, right? Like, there is a fundamental disagreement about what the facts about the technology are, which is so weird to me that we're here and we still are disagreeing about the facts. But as far as a way to move forward, I've suggested this since 2020, 2021. It sounds really corny, but because this is such a hard issue and it is potentially extremely consequential, the more that I guess crypto assets themselves are being used, but also the movement potentially of much of our financial system onto a new financial market infrastructure of public blockchains. Something like a Manhattan Project where we all hole up in a room for several months and actually get people from all perspectives in there, the industry builders, critics, academics, scientists, economists, and I want to be there too, and hash it out in a productive way, ideally.
Gene?
So I think one of the important things to note is that not all of these technologies are implemented the same. A lot of the risks people are talking about are very particularly Ethereum risks, which is kind of a Generation 2 blockchain. And I think the key point, the thing I think the SEC should keep in mind is who's the man behind the curtain. Because a lot of these technologies proclaim that they are decentralized, and the running joke is Dino decentralized in name only. But when it is truly decentralized, when there truly is no single party and everyone understands how that process works, I mean, if you want to hear scary technology upgrade things, let me tell you about SSL. So, I think that the regulatory regime, and I will echo something from the earlier comment panel, interoperability, yes, between traditional and blockchain. Interoperability between blockchains is actually an unsolved mathematical problem. So when you actually sit down with cryptographers, there's hope that things like zero-knowledge proofs might work here. But I don't know that there's a way that you can bridge a securitized, a token security from one blockchain to another without a license from the SEC of some sort. So, it's an interesting and problematic item that we need to think about, who has that control, who is the man behind the curtain. I think that's the guiding light for where there should be regulation and where there maybe not should be regulation.
Kelly?
Yep, actually, I agree with Jean's point. When I think about what, this is an awesome opportunity, but with that comes an awesome responsibility. And I think the best thing that the SEC and other supervisory authorities around the globe can give to those of us in the industry is a set of principles. So it's a set of principles that have to be incorporated into solutions or into the design of the technology itself. And a couple that I'd offer that we take with great seriousness and great humility at Digital Asset are, yes, public. I mean, if I had said, all of you, good news, we're all going to get in a room together here and form an ecosystem, but first what you have to do is, that would be great, and we'd all have a good public market, but first what you have to do is take all your IRA statements and your brokerage reports, and we're going to post them on the wall, and everybody gets to see everything, and there's a group of people sitting in that room over there. You won't know who they are, but they're going to be the validators who will decide what you can actually buy and sell. I mean, it would be laughable, right? So it's equally laughable to assume that that type of evolution of technology or product or asset in the securities markets for this market and for the markets around the globe is the right way to go. So I think it's about getting to a set of principles that can be reflected. Public, yes, but privacy and permission is critically important. The financial markets rely on it, and it must be consistent in any solutions that go forward.
Well, that was a high and productive way to end it, so I'll end it there. So thank you so much to all my fabulous panelists. This was a very lively discussion, so thank you so much for your engagement.
This is a bit of a Manhattan Project Light, or Project Light over here, these roundtables. We've been trying to gather different voices, and unfortunately, we can't kidnap you for months at a time, but if I could, I would love to do that. So thank you again to our panelists, and thank you, Tiffany. You did a wonderful job moderating. Applause, again, come on. So I really appreciated the conversation around risk on this panel, both the commentary on the risks that we may not be fully considering and the mitigating factors that can reduce those risks. For most of my career, I've worked closely with prospectus disclosures. And in every prospectus I have ever written or reviewed, there are pages of risks. What this illustrates is that the goal of financial regulation is not to get to zero risk. In fact, it would be a bit reckless to create a regulatory framework where the price of entry is a demonstration of zero risk. The benefit of conversations like these are they help us understand risks so we can create regulatory frameworks that are consistent with our agency's mandate and statutorily appropriate consideration of risk. The benefits of ideas like a regulatory sandbox are they help us pressure test frameworks so that we don't go from children playing on a bridge to a Mack truck driving on it. This conversation has given me a lot to think about, and I hope we can have continued engagement from the panelists and the public on some of the great points that were brought up today. Please provide any feedback you have on the Crypto Task Force webpage. I will pitch it every single time I'm at this mic. We have a great written input web form where you can provide any analysis that you've done or any thoughts that you have. And we hope that you'll join us for our final panel or our final roundtable on DeFi and the American Spirit on June 9th here to end our spring sprint towards crypto clarity. I think we're basically there. So one more roundtable is going to do it, and we'll be done. So thank you all very much, and have a great rest of your evening.